understanding price charts. Because no matter how you trade, no matter what you trade, you have to look at price on charts. Because it's the only way where you're going to see where price is going. It's the only way that you're going to be able to figure entry and exit points. It's the only way that you confirm the price is moving in the direction you want. And it's the only way you can really see historic values. Because all a price chart does is simply take the value of the asset and put it in an easy to see visual format. Now, it is no secret that online trading can be performed more efficiently if you possess the necessary tools. And a good place to start is with your charts. Now, ETX provides you on the trading platform a phenomenal set of charts. Now, a lot of us, or a lot of you guys, go out into the marketplace and you find charts on TradingView, which we're going to use tonight, or you find charts on investing.com or Forex Factory. The problem being is charts come by feeds, data feeds. Data feeds are extremely expensive. I mean, unbelievably expensive. So when you get to free charts, and nobody's trying to deceive you, if you look in the information, it's going to tell you some of the charts, like TradingView, if you're looking at the free charts, have a 5-second delay. Well, is that all that crucial? It can be. And when you're in the markets to trade for profit, you need the best information possible. Now, like on TradingView, like I said, the free charts have a 5-second delay. If you open a general account, you get them almost immediately on some assets, and it tells you which ones. Some of the more unique assets, you have to have a higher level of an account because it's just costing them a lot more money for the feeds, because the feeds come from different providers. The providers are based on contract with the different markets. You know, Forex comes from a lot of places, and you a lot of times see where it's coming from, because there is no finite price in the Forex market. But the stock market, the commodities market, the futures market, they're all coming by feeds from those exchanges, and they charge a great deal of money. When you stop to think about it, the futures market, commodities market, and indices and stocks are huge. So keep in mind that basically the best charts you're going to get are going to be from your broker, because they're already paying for the feeds. They've got to get the feeds to come in to be able to give you trades and allow you to trade and give you the up-to-minute prices. So to feed them into their charts, you're getting the fastest feeds with the fastest data that ties right back to the trading platform. So just keep that tucked away. Now, whether you are going to be a fundamental trader, a technical analyst, or a quantitative analyst, there are a number of methods used by traders to predict movements of currency pairs or other assets. Some traders focus on news and interest rates and economic variables, while others prefer to use charting tools and indicators to guide their trading decision. However, no matter your trading method, you'll need to know how to read a financial chart. There is absolutely no escaping it. You must crawl before you can walk, and charting is no different. You first need to have a good understanding of the basics before you can progress to the more advanced stuff. So let's start out. What is a chart? A price chart is simply a graphical depiction of the current and historical prices of an asset. That's all it is. A price chart doesn't do any analysis. It is simply giving you price action, price points, prices. That's it. Okay. It gives you this based on opens, highs, lows, and closes, and all the price charts around the world are going to have the same information, especially when we're looking at historical information. Now, charts have different display modes, And they fall typically into 3 different overall models. The most popular, especially with online traders, CFD traders, is Japanese candlesticks. Now, there are theories about using candlestick patterns to predict price. Candlestick analysis is said to provide a nearly instant sentiment read on the markets. But you need to understand and learn how to read candlestick charts. And even though it's the most popular, a lot of people don't spend the time actually learning how to read them. So the most simple of all the charts is a line chart. Line charts are a good way to simplify the display of a price. A line chart will show you the closing price for each period. Now, a line chart is simply, if you're looking at a half-hour chart or a 1-hour chart, 1-hour chart, at the close of that 1 hour, it puts a dot on the chart and it connects all those dots together to give you a line. Okay. Now we say it uses the close. The fact is today, because of Java charts and HTML charts and all this computer data and development, most of the rules have been thrown out the window. Because most charts, or the charts today, will allow you to decide, oh, I don't want the close price, I want the median price, or I want the high price, or I want the low price. And you can set your line chart for either one of those. But when we talk about the line chart, most of the time it's the closing price for the period. So another way to display price is by using a bar chart, which is ultimately my favorite. Now the bar chart is very similar to a candlestick chart. And I think the only reason candlestick charts have grown so much with online trading is because everybody likes the colors. And they think the colors are telling them something. But a bar chart will show you where the price opened, the high, the low, and the close. It gives you a great graphical depiction of price movement. So as you see in a line chart, now for the 3 examples we're looking at tonight, we're using the Euro US dollar on a 30-minute chart. That means each 30 minutes, the open, the high, the low, and the close are put on the chart. Okay, and a line chart is only the close for every 30 minutes. A bar chart, so now we're looking at a bar chart for the Euro US dollar 30 minutes. That means a bar is placed on the chart every 30 minutes. Each one of those bars, those up and down lines you're seeing, is the open, the high, the low, and the close for that 30-minute period. This chart on your screen is the exact same time frame as this chart. Now you can see the line chart doesn't really give you much information. It just gives you a general look at where price had moved over the day. When you look at a line chart, a bar chart, you actually now have a graphical depiction of the marketplace, and you can start to see some type of commonality. We can see here, look at all of these doohickeys we had at the same price. Here, look at this downtrend. Look at this trend here. We can see that all of those prices stay right on that trend line. Okay. So we can start to see some things that make sense. Look at this price at 112.06 and how many time frames that price just came up and hit that 112.06. So we start to make some sense of the marketplace. Uh-oh. Okay, sorry about that. I don't know what just happened. Now, a bar chart is a little bit more complex than a line chart, as we said. We put a doohickey, and I just call them doohickeys, you can call them dashes, across at the open of that period. So we were looking at a 30-minute chart. So at the beginning of that 30 minutes, we put a dash to the left. At the end of that 30-minute, we find the price level it's at, we put a dash to the right. We then locate the highest price it traded in that 30 minutes and the lowest price it traded in that 30 minutes. And we connect the high and the low. And we have our bar chart. So our bar chart shows the open, the high, the low, and the close. Sometimes it's called an OHLC. Now, if we step up the ladder from the open to the close, that is a bullish session. If we step down the ladder in that period, from the open to the close, that's a bearish session. Now, today, we can color code our bar charts if we want. But still, most of us use a black bar chart. And we can simply see the open, the high, the low, and the close. But now we come to candlestick charts. Now, this candlestick chart, I don't know why the screen isn't catching up with you here. Hold on a second. This candlestick chart we're looking at covers the same period as the bar chart and the line chart. And if you notice, the price movement is exactly the same. But what happens with the candlestick chart, you can see all those prices and opens and lows in common, except now they're a little bit muddied with these reds and the greens. And too many traders think the reds and the greens are trying to tell them something, besides that it looks like Christmas. The fact of the matter is, the candlestick chart has very little to do with the reds and the greens. It has to do with what's called the body and the wicks of the candles. This body of the candle tells you something different than this body of the candle, or different than this body. We can see some are long and some are short. Some are squat and don't exist. Some have wicks, what's called wicks or shadows above and below. Some have very long wicks. Some have very equal wicks. Now, the fact is, these are simply the same open, high, low, and close you used on the bar chart. But candlestick charts then start developing patterns that you can then use the preceding candle and the post candle to make determinations. And these patterns actually have names. Like this little candle right down here and this one here, they're called dojis. We have things like Hammurabis. We have Marabuzus. We have all different kinds. Then we have the patterns that they make, which goes from three white soldiers to three black crows, to bearish engulfing, to bullish engulfing, to Hammurabi. I mean, you have to understand what these candles are trying to tell you. Once you do, then it makes a very good charting system and a very good trading system. So bar charts and line charts were most popular among the Western traders. Candlesticks have been around for a very, very, very long time, but they didn't really enter the Western markets to the 1990s. Because you got to remember, prior to computerized charting, like when I started trading 40 years ago, we did hand charting. We'd sit there with graph paper and we would do our own charts because there was no computerized charts. There was virtually no computers, and the only one place you could get computers were in big brokers' offices. And those were the days, remember, the computers took up whole entire rooms of air conditioning people, and you had MS-DOS green systems, and you could pull some stuff up, but there's very little you could do. It's not like today. There was no internet. There was no communication. So basically, you had a workstation with a big monitor on it that was tied to one computer in the office, but it didn't go outside anywhere else. So the popularity of candlestick charts has soared, especially with the growth of computers and online trading. Now, a candlestick works just like a bar. Instead, we put a dash across at the open, a dash across at the close. We put a dot at the highest price and a dot at the lowest price for that period. So in that 30-minute period, that's what covers the 30 minutes. Then we connect the dashes across. So we have lines across instead of doohickeys. And then we connect the line across to the high and the low. And we've drawn our candle. If we stepped down, just like the bar chart, from the open to the close, that would have been a bearish session. If we stepped up from the open to the close, that would have been a bullish session. So down, bearish, up, bullish. Now, see all the similarities? Now, the other thing that gets confusing with candlesticks is the color of the body. Back in the old days, and I say the old days when we were hand charting, if it was a bullish session, in other words, a step up from the open to the close, we wouldn't color it in because all we were using was pencils. If it was a bearish session, we just used the side of our pencil and color it in. It was the easiest way to do it, the fastest way, and the most full of information. Today, we switch that to reds and greens. So a white candle, whenever you hear talking about white, and white was really just, it was hollow, you just didn't color it in, is bullish or green today. Black was bearish and is red today. But it doesn't make a difference which color you use as long as you know which one's bearish and which one's bullish. So if you wanted to use orange or purple, that's perfectly fine on your charts. But before you can read a candlestick chart, you must understand the basic structure of a single candlestick. Now, we're not really going to get into that tonight because we have entire classes. In fact, we have a 2-lesson class on candlesticks because it's time consuming. There's 32 patterns of candlesticks and how to read them and how to interpret the bullish and the bearish statements, as well as understanding the shadows and the wicks. But remember, a candlestick chart uses the opening price, the closing price, the high, and the low. So does a bar chart. Now, the fact is, you'll hear all about different types of charts. There's all kinds. There's hollow candlesticks. There's all kinds, but they're all based on these 3 charts, and there's simple other variations that are part of what somebody has tried to interpret. And like I said, with the use of computers today, you can do just about anything. So if you note on the screen, there is no difference. First of all, there's never a difference in the price. So the high, the low, the open, the close are always going to be the same. It's simply how you're drawing them. So as you can see, a bar chart and a candlestick chart have the same information. So it's really the body of the candlestick and how you want to see that. But one of the best reasons to learn how to read a chart correctly is so that you can apply technical analysis. Now, not every trader believes in using technical analysis, but it can be useful even if it's not your primary trading method. Technical analysis relies on price that is on the charts. Most charting systems will allow you to add all the technical tools directly on your charts. But before we can get on to that, we have to understand how to actually set up our charts. Okay. And one of the most important parts of a chart is the time frame. Now, we kept talking about the Euro-US dollar 30-minute chart. Okay. It happens to be one of the most popular, the 30-minute chart, especially when we're talking about CFD and forex trading. But you have charts that go anywhere from 1-minute charts to 240 minutes to 1-week charts to 1-month charts. And all it means is if you're looking at a 1-day chart or say a 1-week chart, you're using the open for that 1 week, the price that has started the week out, the close, which is the end of that very week when the market's closed on Friday, the high, which is the highest point it reached for that week, and the low for the lowest point. If you're using a 2-hour chart, it's the same thing. The beginning of those 2 hours, the end of those 2 hours. The highest it went, the lowest it went. But there's a couple things you need to know about time frames. Okay. Many trading systems will use multiple time frames to determine an entry for trade. For example, a system may use a 4-hour and a 30-minute chart to determine an overall trend for a currency pair by using indicators like such as MACD and support and resistance. And then they'll use a 5-minute chart to look for a rise or a simple temporary dip to determine an actual entry point. But multiple time frames will help you see charts. For instance, in our trading, if you're using a 1-day chart, okay, it's going to let us see how the overall movement of that asset was going. It's just like using 3 different moving average time periods. So if you want to see the historic value or the overall trend of that asset, you would use it in a longer time period. Most traders use a long time period to look at things, a medium-term time period to make a determination whether they want to buy or sell, and a short-term time period to decide the entry and exit points. Now, there's another little secret into charting. It's not complicated, but it's almost like your economics calendar. Most chart systems now, the ones on ETX, you don't have to worry, they're automatically default for you. But most chart systems will allow you to set up the time zone. They're going to give you all the kinds of settings. Make sure you have the time zone on your charts set to the same as your trading and your economics calendar, so you don't misinterpret it. The actual price at the window is actually the current price. But if you want to go back and look at what that price is at 2 o'clock, was it 2 o'clock this afternoon, and you don't have it set, you have it set on New York time, guess what? You're getting the wrong information. Now, so on the bottom of your charts, you'll see the time for the asset movement. Okay. If you haven't changed and adjusted it to your home time zone, you're going to get these wrong. So let's go look at some charts I've got brought up for you here. So we're looking right now at the Euro US dollar 30-minute chart on TradingView. So as you can see down below, okay, as I move my cursor down below across here, we can see the asset price. If I want to see where that asset was trading at 6 o'clock this morning, I'm right there. Now, if I had it on US time, okay, it's going to throw me all out of whack because 6 a.m. New York time was probably about here. So make sure you have it set on your home time. Now, as we can see, we're looking at the Euro US dollar 30-minute time. Okay. I can go over here and I can flip it. And today, because of Java charts and HTML chart, we can flip. So you could start out using a bar chart and move over to candlesticks, go right back to a bar chart. All your technical indicators will stay there. But as you can see, we can see here the line chart. And as I said, most of these are variations. We see line area chart. Area chart's simply a line chart with one side of the chart colored in. That's it. We see candles and we see hollow candles. Sometimes these modern charts give us too many choices, because not only that, I can go to my candlesticks and then I can go into my settings somewhere here. They keep changing all their settings things here. And let's see where. Okay, so once I open the settings, you can see I can change my candles and I can use yellow and purple. I can change my borders. I can change my wicks color. I can do everything and anything and make them all crazy. But as long as you know how to read it, it fits your mind, and you know you have your own, because it doesn't matter. You just need to know which one is bullish and which one is bearish. So let's change them back to red and green. Okay, so that's all that really counts, is for you to be able to set them. Okay. So as I said, we're looking at the euro US dollar only because it's the most popular asset out there. And we're looking at a 30-minute chart. You can see now we can change this to a 1-minute chart or 45-minute or 1-hour chart. So let's see what happens when we click it to 1 hour, because the price does never change. So whatever that price was at 132.10 today, it's still at 132.10, that same price. It's how we're visually representing that price. Because in a half-hour chart, you got a bar or a candle for every 30 minutes. In a 1-hour chart, those two candles were incorporated together. So it could have only reached that new high a half hour ago. And this last half hour, it could have been virtually no movement at all. In a 1-hour candle, we wouldn't see that because we would see the full movement, and it doesn't separate whether the movement was in the first 5 minutes of that time frame or the last chart. It only gives us the open, the high, the low, and the close. But also, if we want to see how the euro is doing, we might want to go back to a 1-day chart, because that's going to give us a different perspective of how the asset is trading. So if we were to go back to a 1-week chart, look at that. We can see the euro back in 2014 was trading all the way up here at 137. It nosedived in the March of 15, and it's really been fairly much trading in a sideways range, in a fairly narrow range, all the way through to April of 2017. And since April of 2017, it's been in a pretty steady upward trend. But since we hit May, it's been in a very sideways action. So 116 is a very set price for the euro. But that tells us something about where we're trading at. Gives us some understanding of this asset and its personality. Because if we were going to jump it back to a 1-hour chart, now what do we see? We see the euro has been steadily trading on a downward edge, but that's only since October. We don't see that commonality at the 116 range, although it was, but now it's all spread out and we see it all broken down. When we move it to a half-hour chart, we see something much more different. See, the price is still the same, but now, because we're trading in CFDs, we're trading in very short-term time ranges. So we can see that over the last few days, the euro has really gained some momentum. It's moved, it's not been a big move, but it's moved from 114.30 up to 115.30. It's been a steady movement, but is it an uptrend? No, it's a very short-term uptrend, which we could have capitalized on, but we wouldn't have ever seen that in a 1-hour chart, a 1-day chart, or 1-week chart. So for our trading, we might want to decide that we want to trade the euro to go up, and where we would find an entry point in the shorter term. Right. When we break it down to a 15-minute chart, we even get more precise information. So time frames are ultimately important to our charts, and you have to understand time frames. So we have the type of chart and the time frame. Now, whether you're trading on the ETX charts or you're trading with, using TradingView for your analysis, they're all basically the same. Somewhere they're going to give you the time frame and the setup. You just have to look for where the icons are that give them to you. But as I said before, some of the most important reasons of using charts is so that you can put technical analysis on it. Because once you've got the price on charts, you've got your time frames laid out, the rest is all about support and resistance levels, trend movement. Because here, see, we can really quickly drop a trend line on here and verify that trend line. Okay. We can look and see common prices for that asset. As we go back Nice thing about the new charts is you put on your time, this trend line, it's going to stay there. So if we go back to a 4-hour chart, okay, we're going to start to see more. Now, this is our trend line that we just drew right here. But we're also going to see a different story of the asset. We can also find support and resistance lines because we can start to see historic prices and where those prices have had commonality in the past. Look at how important this price level is, and it's right where the euro is trading right now. But look at all the problems it's had over months at 115.53. Look at here, look at here, look at here. This is all the way back into September the 20th. So we know that this 115.50, say 115.35, is a difficult area for the euro. Okay. And right now it's acting as a very important resistance level. So we can start making decisions. We can start finding things. We go back to a longer period. We can start finding more historical prices that were important, but we're only concerned with support and resistance. You know, the price 1 step, 2 steps, 3 steps above and below the most common price. But we can see how crucially important this 116.246, the blue dotted line, has been to the euro over the last few months. So this case is all the way back to September. But if we were actually to progress it backwards, we can see again all the congestion we had at this time. But this is really about building support and resistance. And that is our next class, because support and resistance come in many different fashions. And you have to learn that concept extremely well. But in order to do any of this, you have to learn how to use charts. So let's go back, and I'm going to show you a quick video from the ETX platform and how to use the charts and the set up some trading on the charts on the ETX platform. And then our next class after this one, okay, for some reason it doesn't want to do this. Let's see if we can. I'm sorry, for some reason it doesn't want to show the video. I'm going to try it one more time. I'll keep talking while I was trying to get it up here. Okay, but it's very, very important. Our next, no, it just doesn't want to find that video. Sorry about that. So let's go back to my PowerPoint. And now our next class after this is support and resistance. No, it's trends and trend lines. And then the class after that is on support and resistance. And these are the three basic, or this is the steps that you should be building your trading foundations on. Now, charts help traders evaluate market behavior and help them to determine where the security will be in the future. To help make sense of the price movement depicted on a chart, traders developed a number of different visual guides to assist them. These are called indicators. There are hundreds of different types of trading indicators developed to cover every aspect of trading, from trend following to mean reversion. So once you've decided what charts work best for you and what time frames you want to use, then it's important, it's time to start adding some basic information to your charts. Any analysis done on a chart is called technical analysis. Now, regardless of how you want to trade, what information you want to use, and how much you want to learn, regardless of your strategy, you need to put some basic lines on a chart that will help you understand the markets. Every trader should be able to add some basic building blocks, and these are trend lines, support and resistance levels, and volume. So let me pop up some charts up here, and I'm going to show you different ways to use your charts. Okay, so now we see the Euro US dollar, and here I hit it from class a minute ago, and we've added MACD to the bottom, which is a simple trading system. Okay, we could add moving average crossovers also, which is an easy way to help you to pick how trends are moving, to see support and resistance levels, and you can actually develop a moving average crossover strategy. Over here, we're looking at a chart on Bitcoin, and we can see how Bitcoin is using this trend line, and look at each time the price moved down to that trend line and bounced off of it. We also have a strong resistance line up above that we can start using these charts to explain what is happening in the markets. From here, we can look at the same Bitcoin again, but here we're looking at the use of two different lines, a trend line and a support and resistance line that form a triangle. This triangle tells us something about this movement, and we can then guess or predict, because what's happening is price is moving into the apex of that channel, that triangle. It's going to have to break out in some direction. There's a 45% chance it's going to break out and go up, and there's a 55% chance it's going to break out and go down. We're not sure, but we can be prepared to make a decision when it breaks out of this chart pattern. And this is one of the reasons we want to use charts again. Now here is Bitcoin again, and we've just added Fibonacci levels on there. Now we have whole classes of Fibonacci's. Fibonacci retracement levels help us interpret a trend and give us price levels that we should expect a bounce or a retracement to bounce off of. Here, we're looking at a simple chart of gold using candlesticks and a crossover pattern. And then here we're using gold, we're looking at oil, where we're using volume, support and resistance lines, and trend lines to make trading decisions. And here we're looking at chart patterns, and we have a falling wedge and a triangle, which help tell us something very specific about the markets. And all this is done with the use of charts. And we haven't even come up to reading candlesticks. Okay, that comes much later. Okay, we haven't talked about the complex technical analysis or technical indicators. Like down below here, we have RSI on here, and we have RSI breaking out of a channel pattern. So we can see where we built this channel where the RSI stayed in this channel, and now it broke below that, and it's telling us something or alerting us to something. But this is the use of indicators on our charts, from complex indicators to very simple indicators. Okay, here we have RSI in the bottom of the chart, and we have RSI breaking above the 40, and we have bullish divergence, which again, you don't understand what divergence is yet, but these are helping us analyze price movements on charts. So our next class will be adding trends, understanding trends and adding trend lines to our charts. And then we're going to go to class number 3, which will be adding support and resistance and volume. Volume is a crucial tool that's overlooked by too many traders. Because volume tells you the amount of shares or open interest in an asset. And doesn't it make sense to you if a market is about to break out of that triangle or about to hit a Fibonacci level and the market thinks it's going to bounce off of it? Don't you think volume should be increasing? When you see volume decreasing, while you have something in a chart telling you something is happening, that means the traders out there don't believe in it. When you see volume surge, you might have a big hedge fund buying into the marketplace. So there are lots of simple things that we should be using to evaluate the markets, no matter how we've decided to trade. But this just gives us some alert, some forewarning, and helps us decide or interpret what is going on. So thank you very much for joining us tonight. And we'll see you in our next class on trends and trend lines. And thank you for supporting ETX. Let me see if I can pop up the video and see if it'll play now. Sometimes the system just doesn't want. Here we go. We're going to play this real quickly, and then we'll say goodnight. All right, ladies and gentlemen. So that kind of covers everything you need to, the basics of charting. And then in our next class, like I said, we're going to go over trends and trend lines. And then from there, we're going to move over to support and resistance and volume. And over the next few classes, you should learn to actually be able to explain price action and understand what is going on in the markets by using these simple basic tools. So again, thank you very much for joining us tonight, and we'll talk to you again real soon. And thank you for supporting ETX. Good night now.